What's up, guys? We're here on Chris the Insurance Guy podcast, YouTube channel, all the above. We got Tony here with us today. Super wise, intelligent guy when it comes to insurance. No joke. I know he's a humble guy. He's gonna not admit it. But Tony, thanks, man. Thank you for having thanks for being on here and taking the time out of your day and sharing some knowledge, dropping knowledge. Some C4 knowledge, so yeah, Tony, if you want to, quickly just say who you are, what you do, and we'll get into it.
Awesome.
Get into it.
Awesome. Thanks, dude, for having me. Yeah, so we are a master agency with SIA, which is a national group. So I manage our local group down in Southern Cal, like San Diego, Orange County area. Been doing that for like 18 years now. So we've got about maybe 120-ish members. And Chris and I work together, and he's an awesome guy. So you guys are lucky that he's pumping content that's super valuable to you. So, I definitely am a consumer of your content as well, Chris.
Thank you.
So I appreciate you having me on. I know we're going to kind of go wherever we go with this conversation, just chatting. So I guess my full disclosure to whomever may be watching or listening, this is just opinion, not financial advice. None of us have crystal balls. We're all trying to kind of read the tea leaves to try to figure out what's facing us right now and maybe what may be coming down the road and all that kind of stuff. So hopefully it adds a little value or perspective. I don't know.
Totally. Yeah, thank you for that, Tony. I appreciate you saying that too, because that is for me too. Like, this is not me giving any financial advice. This is purely half the stuff I say. I'm just like, this is just what I do that works well for me. And if you want to use it, go for it. And that's really what, like, the main kind of gist of this was kind of to get more insights and understand like what your thoughts are. And like right now we're arguably already in the recession. Entering recession, I feel like that's another topic in itself. It's like the recession's coming, but are we in it? Are we not in it? How is that going to affect insurance? And yeah, your 18 years of experience definitely will speak volumes on that. So yeah, Tony, what would you say, kind of based on your experience, how does a recession economically affect the insurance industry specifically?
Yeah, I mean, I think, so again, full disclosure, I'll give you my opinion, and I'm sure there are others listening to this that are way longer tenured in the business that may have a different or better insight. But if you break it down to like brass tacks, right? Because a lot of our listeners are starting agencies or thinking about it or things like that. So maybe not as much history or no history, right, in the property and casualty. So auto, home, business, like that type of insurance. Insurance is a direct function of the economy, right? Because everything that we have, asset and liability, buildings, boats, trucks, products, houses, cars, all of it is workers' compensation insurance, general liability for lawsuit protection, like all these things. They're directly connected to the economy, right? And the economy doesn't function without insurance because it's a risk transfer mechanism. That is why insurance is so integral. And we were chatting right before we came on about like, is insurance recession proof? Nothing is recession proof because, but the difference in like volatility, which COVID injected a whole bunch of volatility. We can talk about that maybe or maybe not later, but into the insurance world. But when you think about it, like whether the economic cycle and what we call a hard market cycle where rates are going up and underwriting is really tight, like capacity is less, meaning carriers want to write less business. And they want to write it at a higher price. That's a hard cycle. Soft is when carriers are making money and, everybody's competing for business. So prices are dropping and new companies want to write more business. And so you have just tons of options, right? And that kind of cycles up and down. That doesn't necessarily overlay specifically right on top of an economic recession or an expansion. Because, for example, hurricanes were still hitting Florida, and Florida still has massive legal system issues and all kinds of issues that are specific to Florida. Anybody that knows anything about Florida, which I only pretend to know a teeny bit from what I've read, it's a really tough environment. Well, we've had an amazing economy for the last 10 years. Well, kind of the last 5.
Yeah.
Forget COVID. But that Florida economically has been doing great, but it still has the pressures of the insurance market, still losing money, right? Because of hurricanes and things. So that's where there's a difference between the economic cycle and the underwriting cycle for profit or loss for insurance companies. So I think to try to keep this a little brief. So with that kind of thinking, look, all signs are pointing towards we're technically in a recession. We've had 2 negative prints of GDP, but with the rate that interest rates have risen, that's slowing home purchases. Refi's gone, basically. That's slowing home purchases down. When you buy a house, you usually fix it up a little bit when you're moving in, or you buy some furniture. All that ancillary stuff that goes around new home purchases or refi, all of that directly impacts the economy, right? And it directly impacts all of us as insurance agents, right?
Right.
Because we're writing a little less business if the painter has fewer jobs or whatever. But
good point. Honestly, I've never thought of that too. Like with the house being purchased, on top of that, there's also construction, painters, electricians, plumbers, all the contractor world is also getting affected by that too, because there's less. Yeah, it's interesting.
Big time, dude. And one of the things we had talked about with the recession about 08, like 08, 09, right? What we call the GFC, the Great Financial Crisis. That was different. The housing market's in a much stronger position financially, like borrowers, right? Now than they were back in the day, because lending was going crazy, standards were going crazy. But what was happening back then is people were writing 100, 150, 200 new policies a month for homeowners.
Right.
Back in like 06, 07. And then everything collapsed. And we watched, so this goes back to your question about, is it recession proof?
Yes.
I vividly remember this, dude. One of our agents was like, we're in the wrong business. These 2 mortgage guys that are referring all this business are buying like Mercedes, and they're buying like 2nd and 3rd houses. And I'm like, dude, I said, I told this agent, I said, the bigger the boom, the bigger the bust. And all our business is a residual income business, which is the power of the business, right? New business is the lifeblood, but renewal is really the power of the business. So what happened? All those folks are gone, bankrupt, lost their houses, lost it all back when everything imploded in 2008. But we were just sitting here chugging along. And yes, our new business dropped, right? Tremendously. And that will have an impact, right? But it's not a one-to-one correlation, because each line of business, personal, commercial lines, and then within the segments of that get impacted differently at different times, depending on what's going on within wherever you live in your state. And then also, just generally kind of the trends of the economy within specific things. I don't know if that answered the question or not, but
it's it's insightful for sure. I think people that are like fairly new to the industry, like I remember specifically hearing you talking about hardening and softening of markets, made zero sense to me when I first started, especially because independent world is different than captive world. Like just working at Farmers or State Farm or Allstate, those are, you get what they get and they're underwriting and that's it,
Right.
versus here on the independent side, we work with, a variety of different companies that they may be even in different places within their own little hardening and softening, which is another interesting point because there's like multiple layers to this too. It's not just,
That's actually something I would love to just comment on real quick.
yeah, for sure.
Because now, guys, anybody that's listening or watching, sorry, this is going to be California specific for a
Yeah.
bit, but it also applies to other states. Okay.
Mhm.
In normal, so in what's happened for us guys in California is that in the last 28 months or so, give or take, the Department of Insurance kind of paused on doing the rate filing reviews and approval process for the insurance companies, right? For auto and home. And they had their reasons for that. And I don't know.
How long did they pause, Tony? Do you know?
It's been over 2.5 years. So like I was just telling you before we came on, right? Allstate just got their approval, first one to get approved.
Yeah.
That was at the end of last month. It was February or March of 2020.
Yeah.
So
Wow.
think about this, guys. Like if you are selling pizza for $12, and this is again California specific issue, but if you're selling pizza for $12, it used to cost you $4 for cheese per pound. Now it's 18, except you're still forced to sell $12 pizza. How long are you going to answer the phone? How long are you going to keep the front door open for customers to walk in to buy mispriced pizza? You're not. That's why Geico I think a big reason why Geico shut down their offices in California and things like that. They need to slow down the mispriced pizza sales.
So that's another thing I want to ask you, Tony, because slowing down is the hardening. So that's something I don't fully understand. This is a good question for myself, a selfish question. Why does slowing it down and keeping the rates higher allow them to control their I guess, bleeding?
So I'm going to go back to the pizza analogy.
Yeah.
If we know that our cheese cost $4 at one point, now it's costing 18, but we're having to sell our pizza at 2020 rates, right? We're having to sell the auto insurance at 2020 rates, $12 pizza.
Okay.
In that analogy, we know exactly what the cheese cost.
Right.
If I write you a $500,000 auto policy and I put $1 million umbrella policy on top of it, I don't know if you're going to go hit and kill somebody tomorrow or never.
Yeah.
I don't know my cost of goods sold.
Right.
Like I know the total potential cost, but I don't really know what it's really going to cost. But so the issue, right, is like for carriers, this is again my opinion. I'm not a carrier dude. I've been on the agent side my whole career, but from what little I know and what I think I know, what happens is if you write a new policy, right, you don't really know the profile of what that client's like. So they're historically in the industry, new business runs a higher loss ratio, right? Has more claims historically than renewal business.
Sure.
So when you're writing a new policy, not only are you taking on a risk that you're not exactly sure how that client's going to perform, if you're in a situation where like we are in California, where the rate need, because of the loss trends of inflation and labor and costs of vehicles or whatever, is up higher, but that you're being forced to write insurance at a lower price, you're going to say, we want to slow that down.
Right.
We don't want to sell the $12 pizza. And when you do that, then the business that you currently have on the books, your premiums are earning through, maybe you're figuring out, oh, hey, Chris said that he drove 5,000 miles on his policy during COVID, but we've just validated his mileage.
Dude, it just clicked.
But he's actually driving again, like 17,000 miles based on the Carfax when we did his renewal.
It just clicked.
Yeah. And so the ability to kind of underwrite and go through your existing without taking on a bunch of mispriced business
Mhm.
up front. Um,
I think the key there, Tony, was that the new business is the most risky for insurance carriers because
it is.
that explains so much because yeah, going through renewal, you can see their mileage. They went and got a smog check. Now they got updated on the mileage. Now we really know it starts to catch up. And then also it buys kind of the carrier a little bit of time also until stuff catches back up. Am I right? Is that kind of
Yeah.
also like you're buying time a little bit or?
Yeah, because and so what's happened here in California though is because we haven't had rate approvals, right?
Mhm,
What's ended up happening is that the existing book of business has
mhm,
become deficient in rate. Again, there are other people in the world that could be way more technical and better than me at explaining it, but
uh-huh,
but my view or my opinion is that that existing book of business basically became kind of subject to all these inflationary trends. The thing you got to keep in mind too is inflation is brutal for
mhm,
insurance companies. Why? Well, think about your accounting in your agency. You have assets, you have liabilities, right?
Yep.
An insurance company has liabilities. They have to pay claims, right? They have exposure, right? If they write Chris and Tony's auto and home policies, whatever, okay, we now have that exposure on our books. But we're getting the premium and we're taking the premium and we're going to invest a portion of that, right? We're going to build our reserves and our investment portfolios. But now that Chris's house catches on fire and has to be rebuilt,
Mhm.
that's going to cost maybe 20-30% more than what it did 3 years ago. But I've gotten
Yeah.
no rate on Chris's policy for 2.5 years. So what happens with inflation is it destroys the equity markets, right? Which
Mhm.
we've watched the stock market get pummeled. We've watched bond prices get wrecked. And so their asset side of their balance sheet has been impacted.
Right.
But the claims inflation has continued to go up. And
Yep.
so inflation
Not a good
actually
formula.
hurts, yeah, it hurts the investment side, but it inflates the claim side. And again, as agents, we don't think about this crap because
Damn.
we're
Yeah, that's
agents,
crazy.
right? We don't take the risk, we're not paying the claims. And so I think a lot of times for us when we're at the point of sale, we're
Mhm.
just like, oh my gosh, why is this insurance company like making my life so hard? Like, I just want to write some business, get paid.
Yes.
And but it's all those mechanics behind the scenes that are the things that are creating for us the reduced capacity, aka a much harder market, right? Meaning the
Got it.
companies don't want to write as much business, and when they do, they're going to charge more rate when they can get it,
Mhm.
eventually. But anyway, so that was kind of a long-winded, winding
No, no,
trail
no.
on the recession question, but
Totally. No, I think everything you said there, it was definitely extremely value packed. So I no, I definitely appreciate that. It's probably like for some of the newer guys that are watching or gals watching this, you might have to rewatch and like re-listen to it because it is a lot to wrap your head around, especially early on. Like I said, I didn't understand it at all. And now even just there, several things have clicked for me, which is good stuff. Um, Tony, so I guess the next thing I would say too, so now that we're aware of what's happening and like where we're at, what can like agents or what in your opinion can agents do to navigate these choppy waters of insure? Dude, I'm seeing it firsthand. Like I'm going in, like you said, I just want to sell the damn policy. I just
I
want to
know.
get the deal done. And like that's really that's what obviously protect the customer, right? Get them the best possible deal, number one. And then sure, earn our commission. That's what we're here for. And I think everybody is on the same page, hopefully. But what can we do to like navigate these waters and try to set ourselves up for success? Because it's just not, yeah, it's not easy right
No,
now.
I know, dude, I know. So, I want to answer that question, but one thing I want to just mention as a pretext to my answer
Yeah.
is right now, what's super important, I believe, for all of us to understand on the agency side is
Mhm.
that the macro trends, like the mega trends that are going on that none of us control, they're impacting all of our carriers, and the carriers are reacting in ways that we, in my career and definitely in your career, have never experienced before. Me in California specifically, where a lot of the actions that are happening and the restrictions on writing, not wanting to write as much business and everything, like it's very widespread, right? It's not like in a normal market, you have carriers, like you said a second ago, like some carriers are doing this and some carriers doing that. Right now, everybody's doing, it's like peanut butter, like everybody's stuck. Just spread the peanut butter. We don't want to, everybody's mucked up, and just like in a normal market, like 3 carriers make these changes. And so then as an independent agent, you go to your other 2 carriers that are doing well. And then, okay, they tighten up. But by the time that they tighten up, 2 other carriers are loose again. So,
Right.
you kind of like have choice, and you remarket and you do what you do. And that's how we retain our clients long term.
Interesting. Yeah.
So the reason I say this in the context of what do we do is that in the next, I believe, again, here in California, the next 2 to 3 years, we're probably going to see rates go up north of 20%.
It's crazy.
That's how much need there is based on what I've seen or read. And it's not because of that whole peanut butter smattering that's gone over everybody in the market. Every single carrier, it does not matter if it's Geico, Allstate, Wawanesa, USAA, Travelers, Hartford, Kemper, Mercury, Safeco, like Liberty, it doesn't really matter. Everybody's needs rate. And so if you're in a different state than California listening or watching this, your state probably allows your insurance companies to file their rates. Allstate and Progressive, and if Travelers, a few of the other publicly traded companies. If you don't listen to earnings calls, I do suggest you think about listening to some of the publicly traded earning calls. Their question and answers at the end of their earnings calls are always very enlightening. But one of the things that I've heard now from multiple companies is, hey, we've taken 15% rate or 20%, in other states where they're getting their rate increases. So for us, once the rate increases start, everybody's going to take it. Now, what does that mean for preparing as an agent?
Right.
A couple of things. When you're in a harder market, you need to be way more proactive. Like it's kind of a fine line, because nobody cares about their insurance till they have to care.
Right.
That's one of the dirty little secrets of our business, is that none of us care about insurance like that. You and I don't want to like add a car to our auto policy. Like that's not the top of our list in any day.
And just real quick, Tony, that is one of the best lines that I use a lot. I'm like, nobody thinks it happens to them until it actually does,
Yes.
when you know what I mean? And also nobody really cares about how much they're paying when they have an actual claim. Like
It's true.
the time that, you don't want to find out about your coverage at the time of a claim. Like those are a couple little lines that I drop to customers. I'm like, you're not going to care about how much you're paying each month when you're on the side of the road and somebody's injured, and you're going to be calling me just happy that you got the right coverage. Let's get this going for you. Like those are good. Just real quick, I want to throw that in there.
Totally could. I 100% agree with that. Like, I think, and this is one of the challenges independent insurance agents, right? Is that because our clients have been conditioned, or prospects have been conditioned to all about price. It's just price. It's speed and price. Like that's what, unfortunately, some of the big advertisers have made it about.
For sure.
But in the moment of truth, in the moment of crisis, in the moment of need, there is no other industry that actually restores you to the way you were prior to the loss. There's no, and this is the thing, like about insurance, and especially for like our younger, maybe there's some younger audience, and I'm 49, guys. I have a lot of white gray hair. If you can't see me, yes, I'm explaining my look and feel here. Chris is the Dapper Dan. But guys, like, you think about benefiting society and people, businesses. There is honestly, yes, a lot of people think insurance companies, they hate it. It's out to get them. They're not going to pay, whatever. But the reality is like, if Adelphia writes a wonderful like auto home umbrella package for somebody,
Mhm.
and we have personally experienced this where there's been fatality claims with young drivers,
Mm.
drunk drivers, that if they didn't have the umbrella, their entire family financial life gone. So, anyway, sorry, that was a quick rabbit trail, but I couldn't agree more on that.
Yeah.
But I do think that being proactive in a
Mhm.
harder market when because what do our clients assume of an independent agent when they're working with us? If you've had a client for a few years, they assume, oh, my rate went up. I'm going to call Adelphia. I'm going to call Tony, and
Mhm.
he's going to shop me and get me a new thing, a new policy. And
Right.
that's one of our value pitches. Like, hey, we want you for a long time as our customer. We have a lot of options. If something goes wrong or we need to change your policy, we have options. We'll do that for you.
Right.
That's one of our values.
For sure.
But that's the mindset of the client. Well, right now, what do we not have? A lot of
Yeah, that's right.
choice. Right? Even though we have, like, you have some of the best companies, right, that you represent in your agency in California. You guys represent some of the top companies.
For sure.
So we're struggling
Mhm.
even with the best companies. And
Yeah.
so that's when I talk about being proactive, what I'm trying to say is, if you know that, if you, number one, you better freaking be downloading your policy data, which I know you do.
Yeah, we do. We do.
Like, if you're an independent agent out there, and if you're don't even know what the heck I'm talking about because you're an exclusive, or just all that means, policy download just means that the insurance company you're appointed with transmits electronic policy data into your agency management system, or your CRM, if you want to call it that. Why that's important is because you can set your alerts at certain thresholds, right? So
Mhm.
45 or 60 days before the renewal, you get your download. Maybe you've set the alert. There have been basically no alerts because there's been no rate increases. But if you set
Yeah.
it like at 5% or 10%, you can kind of get an exceptions report and be like, okay, hey, Tony's policy just went up like 23%,
Right.
with X company. Let's look at it.
For sure.
Okay.
Yeah. How do you, so yeah, what, like then it's just a matter of what your process might be. And there's different practices, I think, for that. Um, yeah, because also when there's no choice, that makes it pretty tricky.
Well,
Um,
and that's kind of where I'm going, is like,
yeah.
when you know that there's no choice, and when you
Right.
know that every carrier, regardless of channel, exclusive channel, direct to consumer,
Yeah.
independent, is going to be raising rates without question, then
For
it's
sure.
like, hey, Tony, we did a review of your situation. You know what? Your policy went up 23%.
Mhm.
We've already looked at all the markets, and you know what? AAA is going to be taking rate. Farmers has already filed for rate. Geico's not even in the market right now. Like,
Yeah.
we understand this environment sucks, and getting a rate increase sucks. We understand. And normally we'd be able to review your situation and potentially have a different option, which when the market unkinks itself, we will have those options. But in the moment right now,
Yep.
if you decide to go shop and leave, that's your prerogative. I'm just telling you that the
Mhm.
whole market is in trouble right now, and we just have to kind of work through it. So when I talk about like being proactive, you don't
Yeah.
have to have those conversations when everything's cranking along, a new business is flying and
Yeah.
rates aren't going up. I think the other thing too is it's a challenge right now, cross-selling.
Mhm.
Um, for carriers who have a lot of auto, they might want more homeowners cross-sold, sometimes vice
Yeah.
versa. The challenge with that is that you may have a situation where you have a client that
Mhm.
is already happy and put to bed, and you start cross-selling and marketing to them, and you might disrupt their mindset, and then you can't actually solve the package problem.
Right. Right.
So
Yeah.
it's a balance, like it's a nuanced thing, dude, when
That's
you're talking about like renewal reviews and cross-selling and
It's interesting because when you talk to different agents about it, Tony, some say like, for sure, we hit up everybody on renewals and we talk to them and I think whatever, and some say, you know what, we don't even, dude, we don't talk to them. We just leave it. We don't want to wake up the beast and like scare, stir the pot. So I think it's just a matter of like, what do you, what would you want if you were a customer, and how do you want to operate your agency? And then committing to that one process. Because I think it can go both ways. Like you can get, if you do 10 of those calls and half of them are like, sure, give me the homeowner's quote, and 2 of them convert into a policy, but then agitated 3 other customers that cancel and you actually lost 1 and
Right.
you lost 3, you gained 2. Is it worth it?
It's hard.
So that's the fine balance you're talking about. It's
Well,
interesting.
and I think you hit the right point, and then we'll get back onto whatever your questions are.
Yeah.
This is how it always goes with us, dude. Right? We ramble. Sorry, listeners.
It's good stuff though.
Or
It's good
viewers.
stuff.
You hit a really important point though, right? So like,
Mhm.
if your main lead source is just mortgage referral, monoline homeowners, right?
Right.
When somebody's buying a house, now granted, that market slowed way down now compared to even 6 months ago because of the way interest rates have risen. But
Yeah.
no new home buyer wants to talk to Tony about his auto when they're buying the home. They gotta move, they gotta do this, signing a zillion papers, like, and
Yeah.
so your referral relationship with the mortgage broker is, hey, I'm gonna make this as easy for you to get
Right.
that loan closed. So you get paid, client's happy, I get my policy. There is nothing built into that generally about auto and cross-selling and this and that. Some agents do that as their process. But my point is,
Mhm.
whatever your process is, however your new business pipeline was coming in will dictate how you're going back after that in-force book, right? So
Right. Right.
anyway, like that's a whole nother long discussion about, how you're setting up your process and what your business processes and kind of
Yeah.
structures are. But anyway,
So would you say like processes overall, like just having a strategy and a process to commit to, whether it's following up with them, checking in with them, saying, understand. I think what you said there, Tony, with just being like, hey, look, we understand your rates have gone up. Um, and this is something we're not just seeing in California, we're seeing across the country. It's happening to everybody right now. Now, I know you want to probably one thing we can always do for you is shop around. In this case, we got to stay put. We got to ride this out. And in 1 year, next year, 2 years, we can take a look at it again and we can shop it for you and see what the best option is. But for now, stay put. We'll do everything. Make sure you have all the discounts, make sure you have everything available. Let's review your mileage. Like those are kind of little things that you can do. And just I think what main thing is like, be prepared because the inbound calls are going to start to come up with that. So seeing them as opportunities, even to like take those calls, because we're going to get them, like we're going to get those calls. And then
Yeah.
it's a matter of like, what are we going to do with them? Are we going to be in like with our, are we going to be on our heels and not know what to say or what to do? Or are we going to convert it, take it into an opportunity, review, maybe, hey, by the way, do you have life insurance for the more protecting the mortgage? Like that's another, just several things you can do, but I think it's just a matter of being ready for it.
Totally. Well, and I think something that you've been talking about recently on some of your other podcasts and videos is, if you're more of a personalized heavy agency
Yeah,
and you've dabbled in small commercial or commercial lines, but you really haven't done it, again, that area of the market has its challenges. There are certain pockets that are challenged, but there's still more smooth sailing, right, on the commercial line side, and you
for
can
sure.
target. But I want to come back. So the balance is really important,
Mhm.
right? As you kind of build an independent agency, you want to maintain balance, because
Mhm.
when a certain segment of the market goes hard and it's really tough, ultimately rates are gonna go up and your premiums are gonna grow. You may not grow your customer count, but your actual premium will grow.
Right.
This is something
That's interesting.
that's gonna happen. So two quick things, when you're talking about that, as far as like talking to the customer with the rate increase, and how do you prepare your staff and whatever. So again, this is California specific, and this is just, I may be wrong, totally 100% wrong, but what I firmly believe is that in the next 24 to 36 months,
Mhm.
we're going to see 20 to 30% cumulative rate.
Yeah.
So right now, and I was having this discussion with one of our family friends who has a young driver, right? Like I
Mhm.
have a young driver coming up soon, which I'm looking forward to it, but I'm not for
Sure.
insurance, right?
Sure.
But I was telling her, I'm like, hey, I said, I'm like, I gave her the pizza analogy,
Yeah.
right? And I said, can you believe this? I said, but here's the thing, we're still paying 2020 rates.
Right.
We haven't even felt the pain yet for auto insurance.
Yeah. Oh my
And so I was
gosh.
telling her, I'm like, hey, I got a young driver coming. You have a brand new young driver. I'm like, in the
Lock them in.
next 2 to 3 years, like we're going to be paying more.
Yeah,
And so
for sure.
I think that what's important, again, if you come back to the premise that insurance, none of us really want to care about our insurance until we have to.
Yep.
Once it's resolved, we're happy, we're good. But until it comes back on our radar and we have to care about it. But when you're having those discussions, really and truly, I think as an industry, we need to be telling the clients the next 2 or 3 years,
Mhm.
expect higher rate increases because of all the stuff that's happened with inflation and everything else. But we haven't been able to take rate increases for the claims trends,
Sure.
right? We haven't been able to keep it even. Um, and kind of just one other quick little thing.
Mhm.
One game that I've played with some of our family friends when we're talking about insurance is like, hey, Chris,
Mhm.
like, how about you and I start an insurance company today?
Yeah.
Except the only rule is we got to like charge rates from 2020.
Right.
Do you and I want to take our $10 million or $100 million if we had it and
Mhm.
be like, yeah, that's something I want to do? No, the answer is actually no, maybe hell no. Um, and so when you say that to a customer and you say, look, this is kind of like we need rates, but we're way behind. And you and I can look back the last 2 years and be like, hey, this is what happened with the cost of going to Chick-fil-A. This is what happened to my gas. This is what happened to I go get my car fixed and it takes 3 months, like there's no
Yeah.
computer chips, whatever. But these are basic things that we as agents don't actually do a little quick scenario with the customer if they want
Yeah.
to take the time to care. A lot of people are just like, I don't freaking care. I don't just get off the phone with me, huh? But if you do
Yep.
have a client who's willing to listen for 30 seconds,
Mhm.
you can convey a little bit of the challenges in very simple ways.
Right.
Anyway.
I love the analogy too, Tony, because like it's been happening with me with customers, and I've been having to kind of explain these situations several times now. And just to keep it super simple, it's just, the companies are, they're paying out more claims than they've received premiums. So, and that happened because of the carryover, mainly because of COVID, and the slowdown of the money that they received, and now their claims are way up here and the money's down here. So yeah, if you can somehow formulate that into even like I love the analogy, because that even maybe is something I'll think about. I don't know if the pizza one, I'll steal it
Pizza,
from you, but yeah.
well, so I'm going to give credit to Rich, one of our members who was in the restaurant business, and
Oh, gotcha.
we spent about 30 minutes talking about a little deeper level on the mechanics, similar to what we're talking about here, but a little more technical.
Mhm.
And he's like, at the end of it, he's like, well, it sounds to me like I'm selling $12 pizza. It cost me $4 for the cheese. Now it's 18 because I got to sell it $12. I'm like, yeah. And then I took it all the step furthers of saying the front door, the phone, you're not going to answer the phone.
Right.
But I do think, Chris, like
Mhm.
one of the when it comes to dealing with the customers, if they can understand, we can sit here and talk about supply chain and labor and inflation and used cars and all this crap.
Mhm.
At the end of it, really, I mean, other than some simple analogies, telling a client, look, COVID was a black swan. You know,
Yeah.
and if you think about, again, I'm going to use California because annual mileage, and we'll just spend 30 seconds on this.
Mhm.
In most other states, guys, this does not matter to you, okay? Because the annual mileage that a vehicle is driven is not a major rating factor for most states. In California, it's the second most important rating factor.
Really? I didn't know.
Yeah.
I thought that was across the board for the most part.
No, because in other states they use credit
Ah,
scoring,
that's
right?
right. That's right.
So like if you're in different states, and I've never written in other states, so I don't like
Yeah.
technically know how they re-tier people based on renewals and their credit score and all that stuff. But
Yeah.
in California, it's your trying to remember, it's either your year's licensed, I think it's your year's licensed, it's annual mileage, and it's your driving record.
Driving record. Yeah.
Those are the top three.
Right.
Okay?
That makes
And
sense.
so when you were what made me want to bring this up is that when you think about like driving less, but you know, premiums went down, but then the costs went up, the claims went up. That's
Mhm.
exactly right. Because if you in your mind, if you picture like insurance as like a kind of a steady chart that just kind of in trend kind of goes slow and up to the right, you know, insurance premiums just kind of generally slowly rise over time.
Right.
But which is kind of generally how like, you know, businesses grow and
Right.
assets expand. It just kind of little by little. But with COVID, if you imagine a chart, which I think I've shared with you guys, like in
I think so.
the auto chart in California, it's like a huge V pattern, right? So
Yeah.
2020 hits, claims dropped like crazy
Mhm.
because nobody was going anywhere. So the insurance companies had to give back money, right? That's fine. It's legit. I mean,
Right.
there was
Right.
less
Right.
exposure.
Rightfully so.
Yeah, yeah. So
Mhm.
less exposure, but the problem comes in the fact that when we reopened back in June of 21 in California, everybody went back to normal life, right? So annual mileage,
Mm.
it's going along, and then drops like a rock, right? Because nobody's
Okay.
driving.
Yep.
Premiums come down, premium refunds come down,
Mhm.
you know, claims dropped to the floor. Then we open back up, everybody starts driving again, like bam, and it goes back to pre-pandemic levels. Well, the premiums didn't come back. Not only would not have rate increases,
Right.
like you and I were joking about before we got on, nobody called Tony and said, hey, I'm back to work, I'm driving, you know, 14,000 miles a year again, not 4,000 miles. And
Yeah.
so when you think about the magnitude of the impact, if mileage is a really important factor for the rate, when that gets dropped, the premiums drop dramatically. But if
Right.
you don't reflate and re-underwrite or just restate the accurate mileage, what the client is really driving, then what you have is you have maybe premium that drops 20%, 30%, initially rightfully so.
Right.
But then the client starts driving. So the exposure, the risk doesn't come down 20 or 30%. It goes back up because now they're driving 14,000 miles a year, not 4. So they're on
Mhm.
the road 3 times more than they were during COVID, except they're paying 20 or 30% less. So again,
And
if you and I were starting an insurance company and
right.
it's rate for the projected future loss, that's what insurance is. I
Mhm.
just want to try to charge a rate that I can make a little profit for what I think might be my future loss.
Yeah.
That's it. It's basic, right? It's very complicated, but that's the basic
Right.
philosophy. So when your premiums have been suppressed, but your exposure's back up,
Mhm.
that's why the freaking loss trends are out of control. Like that's one of the big reasons, and is why like the annual mileage piece is such an important factor. Again,
Mhm.
this impacts other states because if people are driving more, they have a higher chance of getting in a wreck or hitting somebody or doing something. But it's not as important of a rating factor
Right.
in other states. So it's still a relevant measure across all of auto insurance, right?
Yeah.
Anyway, sorry, that was a complete side trail, but it's such an important element that clients don't really think about,
Right.
they just don't think about it.
And
You
that's
know?
also, that's a great point too, because it makes it, it puts it in, this is also a discussion for consumers. Like what can consumers do for themselves to be not just completely caught off guard at 20% increases in this time, because they're getting a discounted right now. Everybody's living on a,
Yeah.
not a free lunch, but like everyone's living on a nice discounted insurance premium.
Right.
And there's going to be a moment where it's going to be a big hit. So what can you do at this point in time as a consumer to ride that wave up smoothly and not get completely screwed?
Yeah,
That's, I guess, a good
it's
question.
gonna
Maybe
feel
invest your money. I don't know, like put it into crypto, put it into Dogecoin, you know?
no. Yeah, anybody that's into crypto, Tuesday was a freaking another black swan in crypto with FTX and Alameda Research going down, one of the largest crypto exchanges having a liquidity at bank run. Anyway, that's a whole nother topic on the blockchain and crypto. But
Right.
so do not at the moment financial advice. If you need the money, don't put it into risk assets, because we're in a very choppy environment right now.
Right.
Cash is king right now, as even though normally you would say that's not. I think for the clients, like the number one, having an awareness,
Mhm.
right? That you know, it's not the industry trying to completely screw you, right?
Mhm.
Because that's the mentality, is like, I pay for my insurance, I never use it, I just get screwed. The big bad insurance companies always just take my money. And that's how we feel when we don't have claims. But then when we have a claim and we get taken care of, sometimes
Right.
claims go badly. Then you're like, oh, okay, I couldn't have paid for my kitchen remodel because of the water damage. I couldn't have come up with $50,000. I could come up with $1,000 deductible, but I think for clients, having a general understanding, however we can message that in, whether it's automated email campaigns, whether it's during
Yeah.
renewal reviews and phone calls, just simple little things like, hey, this is going to be the trend that's going to be ahead of us for the next few years.
Yeah.
Setting that expectation, because that way when you have that interactions, it's not completely out of left field, because we all want to have some sense of what to expect if we can. We all prefer that as humans. But then you're really looking at like making sure that
Mhm.
the if they can raise their deductibles, it helps a teeny bit, right?
Mhm.
It helps a teeny bit. If there's discounts, like a lot of times, you write a policy, maybe somebody gets a degree or does a safety driver's training, safety program, whatever. I mean,
Yeah.
they,
Bundling. I mean, just looking for everything you can possibly do. Just the
yeah,
bundles, the employment, the group discounts or whatever it
yes,
is, and then keeping mileage accurate. Like if you're
yes,
not over driving, does the car really need to be on full coverage? It's like 90, it's a 98 to a
yeah,
Honda, those are things. And then also I think, aside from what you're saying here, Tony, with like the personal lines, because that is hardening, also seeing where the green lights are at, and like maybe focusing a little bit more on commercial, like going a little bit harder, doubling down on your marketing and knowledge also. Like I just started the course here with by the way, it's really good, man. Like I so far
good.
I've only done 2 sessions, but um just doubling down on your knowledge and like your training and experience, and for the products and commercial, and going where it's a path of slightly least resistance right now, I would
Yeah.
say.
So interestingly enough on that, real quick, um, sorry, nothing's really quick with me, I guess. I love this industry. I love what we
No,
do.
it's great, man. It's great.
A lot of people think insurance is boring, and it can be unless you make it not be. If you're in the weeds and care, it's very
Mhm.
dynamic. But so what's interesting in commercial is something that nobody on the agency side really even thinks about, because we don't really deal with it, is reinsurance. Let me step back. When the global kind of financial system, right, went risk off, right? So we had a massive like stock market run, crypto was like on fire, like housing market was going ballistic, like everything was
Mhm.
fueled by low interest rates and tons of liquidity, right? Tons of capital just going everywhere in the
Right,
world.
right, right.
And that's a risk on environment, right? That
Mhm.
means lean in, put the money in, let's rock. We're going to the moon.
Yeah.
And as soon as the interest rate environment and this and kind of the central bank kind of perception, because it's actual banks that lend, it's not the central bank, it's not the Fed, but when that started to shift, right, and rates started to come up, liquidity started to tighten, everything started to start to pivot to a risk off environment.
Mhm.
So the point is that there's dollars, there's capital out there that's looking for a return. And reinsurance is an area where capital goes to find a return, right? Well, a lot of the stuff that I've been reading recently is talking about like coming January with
Mhm.
Hurricane Ian, we've had multiple years of really bad natural catastrophe years, right? So the companies, the primary insurance companies like Travelers and Hartford and Safeco, Liberty, all, they take a certain amount of risk on their book, but then they reinsure a lot of it or a good chunk of it. And then the reinsurers can reinsure themselves a bit, right? So everybody spreads their risk.
Hmm.
But when the market is super tight, and this, I'm going to come back to commercial. When the reinsurance market starts to tighten up, that means that the primary insurance companies have to either pay more for their to offset a portion of their risk of their portfolio, of their
Mhm.
book of business, or they're going to retain more. They're going to keep more of the risk, which
Mhm.
means they're going to pay more of the claims if there's a big hurricane or whatever. If you keep more of the risk, you need to charge more, right? I mean, again, it's rate for
Sure.
risk.
Sure.
So what's happening though is that in some of the property lines, both homeowners, certain property lines like wildfire exposed, right? This could be commercial buildings, it could be personal lines, homes. That as the reinsurance market tightens up
Mhm.
and capital is lower or the terms and conditions are more stringent, that kind of trickles back down to what the primary companies that we work with are going to charge and what their capacity is going to be. And so what's happening is some areas of commercial like cyber
Mhm.
have had very, very unprofitable trends, right? And so the rates have gone through the roof. Some areas of commercial property have, started to tighten up. The other thing that's a big deal is large lawsuits, right? What we call nuclear verdicts, right? And I think I shared with the members at our last meeting. I think last year was like the largest jury verdicts,
Mhm.
I think, in history. Over 2 million. I think it was like 2.3 million or something on average. So these are big lawsuit, suits that are being paid out. Again, most of these are insured. A lot of these are insured. So these are
Right.
higher costs. So I'm working my way back down to commercial to answer your question. When you look at workers' compensation,
Mhm.
it is a line of business that um, is still really profitable. It's not as profitable as it was for the insurance companies, but it's still very profitable. So if you're going to be in
Sure.
commercial, we're going to probably see workers' comp stay profitable, and the carriers want to grow that line of business
Hmm.
for the next handful of years. If you're writing like older apartments or big buildings, here in California, we have a homeless problem, we have
Yep.
vacancy problems. And so this goes back to inflation as well. I've heard of a number of different large lessors risk only, right? So these strip malls where there's been a
Yeah.
big fire. And so historically, like insurance companies, like a lot of our companies like lessors risk.
Right.
Well, they're starting to experience large claims, big fires because of homeless folks. Again, that's a whole social thing. I'm not talking about that, commenting on that, what we should or shouldn't do about that issue. But the fact of the matter is you have people camping behind a building, starting a fire, or getting inside of a vacant unit, cooking a little bit, and then accidentally starting a fire. And then it just creates a massive claim. So
Mhm.
There are pockets of commercial that are more challenged right now,
Right.
but in general, like I said earlier, the wind is still in our sails and commercial lines, and
Yeah.
you can target it. Like if
Yeah.
you like your degree was in technology management, I think, right?
Yeah. Operations. Yep. Mhm.
And I think we might have talked about this years ago, but if you are comfortable with technology,
Mhm.
and me personally as a person is not, like we're both agents, right? Like maybe, I mean, maybe I'm, which is not the case. My wife has more tools than I have,
Yeah.
but maybe I really like building stuff, and I'm definitely into like, construction.
Mhm.
Well, Chris should go because he has a natural affinity for technology and a knowledge set that I don't, as Tony, don't have. So the beauty of commercial is, dude, lean into what you know and what you enjoy, and you can go target software developers or data centers or whatever it is. And I can go target my painters and my electricians and the dudes that I want to hang
Yep.
out with.
Yep.
This is the beauty of commercial, right?
That's true. That's a great point too. It's like if you don't necessarily, because it is a massive world. Like, let's just be
Yes.
real here. Like, it's a massive spectrum. Every business you see on the street is its own little subdivision and subcategory of it. And
Yeah.
I'm also seeing that now as I kind of dig deeper into my own knowledge. So yeah, like for me personally, I love contractors. Like I love the electricians, plumbers, roofers, tree trimmers. Like those are kind of like my little niche. And if yours is like, yeah, like a great point, man. Like if you like, um, I don't know, like wood finishing company, like you're really into making wood signs, like boom, you can go after all the wood sign companies or
Yes.
wood designing companies.
Dude,
So good
I
point.
don't know if you anybody who's listening to this, and maybe Seth Godin, maybe you don't. He's
Mm,
kind of a legacy kind of marketing guru, but he had a book called Purple Cow.
mm,
But he has another book called Tribes. The point is that I think I'm going to attribute to him. I don't. I believe I'm remembering this right, but he made the point that you only need 1,000 people in your tribe to be
mm,
successful.
mm.
And so if you think
Interesting.
about it, like the more, using your wood finishing sign analogy,
Mhm.
okay, so you got to look at the addressable market. I mean, like if there's like 13 prospects in your entire geography, then sure, you're not going to make a living as an insurance agent maybe on that, unless they're all like ginormous middle market accounts and you can get 3 of them, then yeah, maybe you'll do fine. But I think the big thing is like you're able to kind of target and lean into what you enjoy. Now, one thing I do want to say, because this does come all the way full circle back to
Yeah,
the economy and recession and everything, when you said contractors and construction,
right.
um, artisans and generals who do commercial lines, you're not writing those in the preferred, like what I call the standard markets, right? You're not writing a general contractor with
No.
Travelers or Liberty, right? They're excess and surplus lines. But your electrician, your HVAC, the plumber, the painter, the flooring
Yeah.
guy, all of those trades, though, are very
Mhm.
dependent upon the health of the housing market and what's going
For
on in
sure.
tenant improvements, right, with buildings and things. And so, one of the things that's really important, because I don't want to oversimplify it, is like just because you have a passion for one specific niche doesn't mean that should be the only thing you do. You
Right.
probably should have 3 to 5 where you can still be a specialist, um, but that your business is not super dependent upon one segment of business. So again, when we're talking about the recession, right?
Yeah.
Mortgage rates have risen the fastest they've risen in history, as far as I'm aware, right? The
Yeah.
shortest amount of time, the biggest magnitude.
I think you're right.
Um, one of the research things that I was curious about prior to '08, my numbers are going to be a little bit wrong here, but the orders of magnitude are close. Leading up to the 2008 financial crisis, it was something like north of $800 billion of home equity was taken out of homes and put into second homes, third homes, flips, boats,
Mm,
trips, whatever, right? It was a
okay.
massive amount.
Okay.
So I looked back
Oh man.
leading up to now. Okay, do you think it was more or less now? Like coming into this time period now, do you think consumers took out more or less home equity? Like
My
total cumulative cash?
my guess is more.
So here's the encouraging thing. The answer is no. It
No?
it, it actually was less than 500 billion dollars.
Wow.
Shock,
It's
right?
interesting. Yeah.
It is,
Interesting.
but what we haven't seen in the last, like during COVID, what we didn't see was people taking out equity to buy a third home in Nevada,
Interesting.
like,
Huh.
right? And so my point is that the market is structurally more sound, like homeowners are more solid
Yeah,
because they didn't drain so much equity out of their houses. Still a
that's
lot came
good.
out, but 500 billion is still a lot. So
Yeah.
with the refinancing dropping off to nothing, basically,
Hmm.
that artist and contractor space that had been living and being so busy over the last 3+ years,
Oh my
that I
gosh.
think that has to slow down a bit, right? And because
Yep.
people were all spending more for everything, gas, food, everything, and credit card usage has gone back up, right? Savings, liquid savings has started to drain down in the
Mhm.
consumers. And so that means that some home projects, there's not going to be a pipeline of dollars coming out of home equity to the extent that there was in the last few years,
Mhm.
and nothing like it was prior to the financial crisis. That's why part of the reason why things imploded so heavily was everybody drained down their margin in their home. And then when they lost their jobs and things went crazy, they were levered up like crazy and everything imploded like a house of cards. But that's my point, is like when you tie
Interesting.
back contractors to the
Hmm.
cyclicality of the economy, that just is something to be aware
It
of,
all just kind of, yep.
something to think about. There's tons of contractors, right? And but when things slow down, you'll see, I watched some of our members' books of business really slow down a ton, who were very contractor heavy. But
Hmm.
when things ramped back up, they also outgrew like tons of agents as well. So it's a little bit more volatile because it's tied to the housing market more. Um,
Hmm.
that is where like other industries are a little bit more stable. But
Yeah.
at the end of the day, you got to go do what you love and what you want to pursue, because then you'll
Right.
put the work in, which is something I love about what you always, promote.
Hmm.
Just, you've got to freaking get out there and just put the work in. It's an
For sure.
activity-based business, right?
Oh, 100%. Yeah.
That's it. You got to raise the awareness of your agency, and you got to hustle. I mean, there's just no short. If you're not driven, just get out of the freaking business. Like,
For sure.
you say this
For
because you
sure.
and I talked about this, like it's hell, dude, when you're starting a business, an agency from scratch. The first
Yeah.
3 to 6 months, total hell. If you have to be able to see through, you know, the first 3 to 5 years to get your base built, because there's no shortcuts. And so that just requires a lot of activity.
For
But being
sure.
smart about your activity too, so
Right. That's another thing. I mean, that's its own
that's this whole,
its
yeah.
own discussion, but like there are so many different tools that you can be using to be efficient with that. Another great book that I read was the 4 Hour Work Week.
Tim
By
Ferriss, yeah,
Tim
it's
Ferriss.
great.
He like at one point I didn't necessarily love the message, because he was saying like work less, and I was like, wait a minute, I don't want to work less. I want to continue this pace, and want to work more. But it's just a matter of like now organizing and being efficient with your revenue generating activity. Really, that's really what it comes down to. And then putting in automation and different tools that are going to set you up to be successful, especially in those, like you said. And that's why, for everyone listening, I think I'm really stoked that Tony's on here, because you're the first person that told me like, hey dude, your first 3 to 6 months is going to be complete hell. And now I say that to so many other agents now too, like on a regular basis.
It's
um
true.
and like that stuck with me too. I remember when he said that to me, I was just like, shit. And then but anyways, I was ready for it. And now little by little, I've learned all these different tools and things that I've implemented that even, I think even older guys in our group should, that I could probably teach them certain things and obviously learn a ton from them too.
Test.
But yeah, man, no, seriously, there's like, that's its own whole discussion, but yeah.
Dude, just as an encouragement to whomever may be listening, right? We just talked about a whole bunch of technical crap, which is all relevant.
Yeah.
It's all relevant to our lives.
For sure.
But look, almost 95% of all of what we just talked about is not in our control.
Right.
What is in our control, and I think something you've been doing really great on, and I think you're a great role model, is if you embrace, they're truly, okay, there is no, in my opinion, no better time to start and build an independent insurance agency. Consumers more and more want choice. They do want advice, but they want it in an efficient, as easy a possible process as they can get, right?
Yeah.
Sure. In the last 4 years in California, the market for property and casualty grew from 75 billion to 84 billion. $10 billion of growth in property and casualty during COVID, like during the last 4 years. Okay,
Wow.
so we're blessed, dude, being in SoCal, like in my opinion. No
Yeah.
offense to the rest of the country, but we have a very large economy. We have a which is what needs to be insured, right? But
Right.
the startup costs of starting an agency are lower than they've ever been. The technology is better than it's ever been. Granted, we have maybe too much technology, so you got to be careful about that.
True.
The ability, like you have executed on to a T, to build awareness for your agency and your brand. We have if you're willing to put in the work to put the video content, to put the social content, just to do the activity, dude, it's freaking unbelievable. And yes, there's no shortcuts. You're going to grind like hell for 3 years just to get to a decent base where you're making 75,000 a year gross. And then you've been there, done that. And then your net is like virtually little, but what ends up happening is it's a snowball, right? And you've experienced this in your own agency. Like as you get the momentum brings more momentum. And it brings different challenges with staffing and different things like that. But you don't have to, if you don't want to be, you don't have to have a physical office, for culture. Some people love that. I think for you, like that's a portion for you that you love because you have your team and you can kind of pump each other up. That's way harder to do in a digital agency. But you have so many different options, dude. So if you're willing to grind, it's a great business, But anyways.
100%. No, totally, man. I think one of the simplest things you can do is something just like this is just get somebody that you like selfishly want to talk to and say, hey, let me interview you. Like, Tony, that's really what it comes down to. Like, this is what this is. Like, I'm just also documenting it for everyone else to like now get the same value that I'm going to get from it from you. And that's why I really do appreciate you seriously taking the time to do this too.
This is fun, dude. I don't think we do enough. I don't think the industry does enough chatting. I will say, like, there's some really cool, like, younger, again, I put you in this category. I'm not that old, dude, but I mean, I'm in 20 years in the business now. But it's cool because where our industry has evolved is like we're way more open to sharing and collaborating. Like 15, 20 years ago, the industry just didn't do that. And so I'm excited about it, but I do think like we need to have more of these just kind of chats, hangout conversations, not just you and me, but just in the industry in general.
Agreed.
Because I feel like there's so many moving parts to the business. And we all just kind of get in our own little zone of what we do. And you really learn and get better by hanging out with each other and just kind of, like, oh, dude, yeah, I did that. That sucked. Or, hey, this is great. Like try this. That's a huge piece, and that I think if you're an agent getting started in the business, engaging, can just, people are willing to help,
Dude, and that's the key too, is the only thing that's going to cut down the time of your success or your failure is essentially what I meant is knowledge. Because if you learn from the older guy who, like, talking to you about like staffing, for example, because the problems do change. Like my problems are not the same as my first year or my second year. Like now my problem is like we have too many leads. We need people to sell the policies. Like we need a commercial, somebody that knows commercial, somebody that handles bit. Like now the service, I don't want to touch COIs anymore. I'm not doing COIs. So like the problems change. The only way to cut that down is by talking to people that know more than you. And like the sharing aspect of it is huge. So yeah, dude, you hit it on the nail, I think.
Yeah.
So yeah, we got to keep making these. These are good videos.
Dude. Yeah, I'm down anytime. I'm down anytime.
Yeah. Sounds good. Well, dude,
Cool,
thank you, Tony. I know we've been on here for a little while now, so I don't even know.
Yeah, dude. Well, you could figure out how you want to distribute and chop this up and all
Yeah,
that
for
good
sure.
stuff. But
For sure.
yeah, I appreciate you having me on and chatting. It's always fun. So
sounds good. Well, thank you, Tony. Appreciate it, man. We'll stay in touch. We'll get some more video content going.
Sounds good. And hopefully, guys, whoever was listening, hopefully it added a little value. And again, just opinion, no fully right or wrong. Don't show me. Yeah,
right. No, it was great stuff. I'm sure definitely lots of value in there. So people probably have to watch this one a couple times, probably.
Thanks, Chris. Appreciate it. Dude.
No, thank you, Tony. Appreciate it. No worries. Thank you.